So now let us begin by understanding how to plot it on the charts, how to plot the trending phase and the non-trending phase of the market. So we have learned the market structure and moving averages as our two price point or two patterns from where we are going to identify whether the markets are trending or non-trending. Let us begin by understanding them on the charts and let us get some hands-on experience of selecting the right strike price when it comes to trending market and selecting the right straddle for a non-trending market. We can trade for non-trending markets, we can trade straddles and strangles. The strike prices, the process of selecting the strike prices that we are going to discuss now. So let us begin by understanding the chart of Nifty 50. We are going to do our analysis for the last 1 year on the year of 2022, on the charts of 2022. So the first trade was triggered on 1st of Jan where the market structure low got formed. As soon as the market structure low got formed, it was trading above the moving average. So market structure low, which is a bullish pattern, above moving average, again bullish, so that we know that it's a trending phase. It's a trending market. So when it comes to trending market, how do we select the strike price? We select the closing price of the candle which is confirming market structure low. Market structure low confirmation, as it's a 3 candle pattern, so the third candle's closing price becomes the selection of strike price. So from here we go 200 points in the money. As the trend is bullish, we are going to select 200 points in the money put option and we are going to short that put. How do we short that? We select the put chart. So now the market structure low got formed somewhere around 17,400. So 200 points in the money, that will be 17,600. So we go short with 17,600 put. So now we'll open the put chart and we'll see, we'll plot 17,600 put. With that, we'll shift the put chart to 15 minutes time frame. And when we shift to 15-minute time frame, whenever a market structure high gets formed on the chart, we go short below the moving average. So the market structure high got formed somewhere around 268. Below 268, we are going to short this put option as we are trading 200 points in the money. So 200 points is the intrinsic value, whereas 68 points is the time value. Shorting 200 points in the money in the trending markets gives us a natural cushion of theta, which is 68 points. So at the end, our intention is to make 268 points, maybe extrinsic and intrinsic value of that premium. We are not just making 200 points, which is the directional move, plus we are making the theta, which is more 68 points. So we short at 268 and we keep on holding that trade till the time the price is trading below moving average on that option chart. So now if you see 17,600 put chart, the trade got triggered at somewhere around 134, and from there we shorted this option at 268 and it became 0 for that entire expiry. Now the thing here is, the strike that we select, whether it's a straddle, strangle or a directional trade, we trade on a weekly expiry. We select the current week's expiry strike. So this 17,600 strike that we selected is expiring this week. And based on it, we capture the delta, which is the price movement, plus the theta, which is the time value. So the next trade that we are going to discuss has triggered in the third week of the expiry. So in the third week, the second trade that we have identified is in the third week of 2022. If we see, a market structure high got formed above moving average. So pattern is bearish, but price is trading above moving average, which is bullish. So trend is bullish, the pattern is bearish. So in this case, we have to trade the straddle or strangle. So now first let us understand the range of the market. So now to trade a strangle, it is very straightforward. How do we select the range? Similarly, how we selected the low for market structure low, the same way we have to calculate, because it's a bearish pattern. So we select the high value of the 3 candle which are forming market structure high. So 2 bullish candle and 1 bearish candle. Whichever is the highest point, we select that highest high and we select the moving average low band to identify the range. So the high value is somewhere around 18,400. The moving average band is somewhere around 17,400. So this becomes our triangle. So if we see the lower band, the moving average band is at 17,689 and market structure high is at 18,350. So we can select 17,700 put and 18,350 call if we are trading a strangle. So strangle means you need to identify a range and you want that market to close within that range. If you see, the markets have closed within the range. So the strangle has eventually become 0. But now if we are trading straddles, we have one more calculation to do. As we know the range, we know the high and low values of that range, we'll sum it up and divide it by 2 so that we get a median value. So adding 17,689 plus 18,350 gives us a median range of 18,019. 18,019 is very close to 18,000. So we select 18,000 straddle. We select 18,000 call, we select 18,000 put and we short them. This trade got triggered somewhere around 250 points, which eventually came to 0, somewhere near to 100, 150 points, and then from there it reversed. But now the idea here is till the time the price is trading below the moving average, we keep on holding those shorts. The moment it crosses the moving average, we square off our position so that we are able to capture whatever points the market has to give. So it's a trailing mechanism. So whenever we enter, we exit either the price going to 0 or the expiry comes, or the third exit is the moving average. If price goes above moving average, we exit. So there are 3 ways of exiting, or maybe 3 ways, 2 ways of trailing the trade and 1 is a forceful exit, which is your stop loss, a trailing stop loss. So one way is you participate in a trade, it goes to 0. On an expiry day, it goes to 0. That means you have no process, no additional work to do. The second way is it might have some premium because one of the strike might become in the money, so that you'll have to square off the position because we are in a short position. If we don't square off, we have the obligation to execute that position. So when it comes to execution, that means if you have sold a call, that means you will have to execute that trade. So shorting an option on an expiry will have to square off the position if the strike becomes in the money. So on an expiry day, somewhere around 3, we'll check the premium and we'll square it off. The third method, the third exit is if price goes above moving average, we exit the position because we are in a short side. We are trading an instrument which is inherently bearish. So till the time it is trading below moving average, that means there is a theta decay. Till the time there is a theta decay, we are enjoying our premiums, right? We are enjoying our trade. The moment price goes above moving average, that means one of the leg is picking up, either call or put, because we have shorted a straddle. So either of the strike is getting nearer to in the money, so that our stop loss might get triggered. So we'll trade. The moment price goes above moving average, we'll exit the position. The next trade is at the end of the 5th week and the start of 6th week. And if we see, when I say week, that means it's an expiry week. I'm calculating our weeks based on expiries. So if we see, a market structure high got formed on 3rd of Feb, which is an expiry day. Completely bearish. But are we initiating the trade on the expiry day itself? No, because market structure high got formed on 3rd of Feb. So MSH got formed, price below moving average plus a bearish pattern. It's a trending move. So how do we trade that? From the closing price of the market structure high pattern, we select 200 points in the money call option. So the strike that we select is 17,300. We short 17,300 call option whenever market structure high gets formed, which is somewhere nearing 344 points. a market structure high got formed. We short there and we keep on holding the position till the time price is trading below moving average. Somewhere between 90 to 100, the price has crossed the moving average. It has come above the moving average. So that's the point where we exit the position. We are able to capture somewhere around 200 points. The next trade that we see is between the 10th of Feb and 17th of Feb. A market structure high got formed, 2 bullish candle and 1 bearish candle. So now we know the range. But there is one more rule. The rule says the price is trading below the moving average and trending bearish. From the closing prices of market structure high, we pick up 200 points in the money call option. Because trend is bearish, market structure high got formed, we select 200 points in the money call option and we short it. If we see 200 points in the money, that is 17,100 call option. We short somewhere around 340 points. We are able to capture somewhere around 80. We squared off our position at 80. So we are able to capture somewhere between 200 to 250 points. The next trade, that is a market structure low. In the same week, we have got a market structure low pattern. So the trend is bearish, but price pattern is bullish. Now this is the time, it's a non-directional market. So how do we do it? We select the range, the lowest point of market structure low and the high of moving average, the high band of moving average, because we are in a bearish trend. So we have to select the high band. So we short the entire range. So high band plus the low value, and if we see the markets have closed somewhere in between that range. So the triangle has gone to 0. Now when we come to straddle, we'll have to select, we have to do one more step of selecting the strike price of the straddle. So it's a sideways range. So the lowest point is 16,809. The highest point is 17,556. Get to trade the straddle of 16,800 put and 17,550 call, and we trade that straddle. That straddle goes to 0 as markets have closed within the range. But if we have to trade the straddle, we'll have to select one more, we have to go forward and do one more step, which is calculating a median price. So we add 16,809 plus 17,556 divided by 2. We get a median range which is 17,187. It is very near to 17,200. So we select 17,200 straddle, go short whenever the price goes below moving average. And if we see the straddle that we had shorted was somewhere around 340 points. Eventually that went to 104. So we are able to capture somewhere around 200 points in the straddle trade. The advantage of trading straddle at this point is one of the strike is going to be in the money and one of the strike is going to be out of the money. So whenever market comes near at the money, because this is what we are expecting, that the market should close somewhere at the median range. Not necessarily that markets are going to close at the median range. They might close somewhere between 100 points up or minus. But the advantage here is when you know the range, we are shorting one of the strike which is in the money. So whenever you short in the money option, you will have delta and theta both. And when you short and the price starts moving near the median range, one option, one strike, one leg of your strategy is going to lose more than the other strike which is going to gain. So that somewhere compensates, and there is lot of fall in the option premiums. That is a natural cushion for an option trader if you are trading a straddle and strangle and if you are trading a range. So that's a gift. So this is how you select the strike prices. That gives us a natural cushion to trade. So now let us come to the next trade, which is in the 9th expiry week from 24th Feb to 3rd of March. In between, if you see, we have a market structure low getting formed, a lower close which is a red candle. The next candle, which is of 25th Feb, we have a bullish close. Bullish candle, bullish close, which is closing above the previous open. A market structure low got formed. And if market structure low got formed, that means the low of the pattern. We select low of the pattern and high. The high value comes from high channel of moving average. We add those values. So the range comes to 16,203 as low value. The moving average value is 17,107. So if we trade the strangle, the markets have closed within the range. So the strangle has gone to 0. The straddle, the price, the median price comes to 16,655. That means we select 16,650 straddle. We short 16,650 call and 16,650 put, and we short it whenever the straddle goes below the moving average. The price has gone below the moving average somewhere at 342 points, and from there the straddle has gone to somewhere around 100 points. So we have made 200 points in this trade. The next trade got triggered in the 10th week of the expiry. If we see, we have a close, a lower close. Lower close is formed through a doji candle. The next day, the entire doji candle got engulfed and we got a higher close. So a bullish close above the previous open. In this case, a market structure low got formed, and if market structure low got formed, we again do the same process. We select the high value, we select the low values. So high value is coming from the moving average, low is the lowest point of the three candles, and we short. If we see, the markets have again closed within the range. As they have closed within the range, the triangle that you have traded has gone to 0. Now, when coming to straddle, because it's a sideways market, so selecting the straddle, the range, the lowest point is 15,671, the high point is 16,920, the median value comes to 16,295, very nearing to 16,300. So we round it off. So it comes to 16,300. We short the straddle. So this straddle was trading somewhere around 290 points when we executed this trade, and it made a low and eventually it turned up and it went above moving average. Whenever it went above moving average, we square off the position. So this is the first position, maybe after 10th week, the 10th trade, which has triggered our stop loss. So this is one of the trade that we have to learn from, that exiting the position is also important. Not every trading strategy or a trading pattern is 100% accurate. So we have to prepare ourselves that if we go wrong, where do we go wrong and how do we combat that situation. So whenever the price goes above moving average, we square off the position, book our loss. So we participated somewhere around 290, we exited somewhere around the same cost, around 300, because at that time you had a theta decay, price was turning lower, moving averages had a bearish slope, and then eventually price went above moving average. So again, we squared off somewhere around the same cost. Now we come to the next trade, which is from 21st of April to 28th of April. If we see, we have a market structure high getting formed below moving average. So the trend is bearish. We go 200 points in the money short from the lowest point. If we select, it was a market structure low got breached, we selected 200 points in the money. The strike that we selected, 17,690, 200 points in the money, we shorted market structure high somewhere around 360 points, somewhere near 115 points, and from there price reversed, it went above moving average and we had to square off the position somewhere around 200. So we made somewhere around 150 points. The best part of this strategy is because when you are trading 200 points in the money, you get natural cushion of theta, and that theta is going to save you, because the moment market changes its direction, we might trigger our trailing stop. There are hardly any cases where you have eventually booked a net loss, because the strategy has so accuracy and it's scientifically made because of the market structure and the moving average. If you're trading non-directional, it is absolutely very difficult, if you follow all the rules, to trigger your stop losses multiple times and maybe book a net loss. But the moment you deviate from the rules, you might start making mistakes, and those mistakes are going to cost you. So I'll request to be at the trading strategy, fix up the rules, you know how to plot market structure high, how to plot the moving averages, select the median range very wisely, it's very rule based, select the median range, short that range. If you want to pick straddles and strangle, we check the median range. That median range has to come nearing to a strike. So if it's nearing to a 50 strike or if it's nearing a 100 strike, you have to trade the strike which is very closer to your median range. So coming to the next trade was triggered somewhere between 21st of April to 28th of April. If we see, there is one more market structure low in between. Two bearish candle and one bullish candle. One bullish candle was a gap up, but largely if you see, two lower closes and one higher close. Market structure low got formed, bullish pattern below moving average. The market sentiment, the market phase is sideways. So it's a sideways action. So we select the range, short the triangles. So the range is 16,888 on the lower side, which is the low point of market structure low. The high point comes from the moving average, which is 17,411. We add that divided by 2 to get a median range so that we can short a straddle. The median range comes to 17,490, which is very closer to 17,150. So we short 17,150 straddle. The price has come below moving average at 202. If we see, continuously kept on falling. On the expiry day, the premium of that straddle was 94. That means one of the leg has come in the money by 94 points. So we have shorted at 202, squared it off at 94. So somewhere around we have made 105 or 106 points in the trade. So this gives us a natural cushion of trading straddles because one of the strike was in the money, and when the trade started moving in our favor, that leg lost more premium than the other leg. So now coming to the next trade, which was from 19th of May to 26th of May. If we see, we have a market structure low pattern getting formed below moving average. So market structure low below moving average, that means the markets are sideways. Markets are sideways, we select the range, the high and low price. Markets have closed within the range. That means the triangle that we have traded has gone to 0. Now let us come to straddles. So the high value is 16,624. That's the moving average value. The lowest point of market structure low is 15,755, which is 15,775. We add that divided by 2, which is 16,200. So we short 16,200 straddle somewhere around 300 points, 350 points, and we keep on carrying this position. This position has gone to 0. So this is the first trade where we have captured the entire move, that entire premium. We shorted around 300, that has gone to 0. The next trade got triggered in the 25th expiry week from 16th June, in between 16th June to 23rd June. Again a market structure low got formed below moving average. The phase is sideways. Strong bearish candle, the second candle is a doji candle, third candle is also doji, but this time the close is higher than the previous open. In this case, again a market structure low got formed, trend is bearish, we select the trend, we select the range, we select the high point, low point, add it, divide it by 2, select the strike and short that strike. So the low point is 15,183, the high point is 16,230. We add it, divided by 2, we get a value of 15,706. We short 15,700 straddle. So we have shorted this straddle somewhere around 380 points, and this straddle has gone to 0. So this is the week where we have made entire 380 points. So these are few expiries where you are going to make good amount of money because the premium of that straddle is 380 and that is going to 0. So you have made 380 points. Whenever it's a directional market, you somewhere make around 250, 260 points. There are straddles and triangle where you make somewhere around 250, 260 points. So this strategy, every week we can capture somewhere around 200, 250 points in Nifty. And if you do it consistently, you will have a very profitable P&L going forward. So the next trade that we have identified, if you see week 28th of the expiry, which is starting from 7th of July to 14th of July. In this, a market structure high got formed. And you see the beauty of market structure here. You have a bullish candle on 7th of July 2022. Then you have a bearish candle, but it is still a higher close. So bearish candle coming up with a gap up opening, and then you see a selling pressure. And ideally when we compare, we have to compare higher closes. So the first candle close is bullish, the second candle close is also bullish because it's a higher close. The third candle is a bullish candle, but it has given a closing below the previous open. So this is forming a market structure high, and if you see the colors are not complementing. You have a gap up opening, but the candle color is red. You have a gap down opening and then the price coming up, which is again a lower close than the previous open, but the candle is bullish. So these are some of the special cases, but they're still market structure high patterns. So this is a market structure high getting formed above the moving average. So it's a sideways action. So market structure high above moving average, bearish pattern, bullish trend, not complementing, becomes a non-directional market. So we pick up the range. So if we see markets have closed within the range, so if you trade strangle, that strangle is profitable. But when we come to straddle and we pick the price, the low point is 15,806, the high point is 16,275. We calculate the median range, which is 16,040. We go short somewhere around 171 points. That option has gone to 110. So we have shorted this option at 270 points. That option has gone to 100. So in this move, we have captured 170 points. When the price came below moving average, it was already below moving average. We have gone short somewhere around 270 points and it has gone to 100. So we made somewhere around 170 points trading this straddle of 16,050 points. So let us come to week 29 from 14th July to 21st July. So this is the 29th expiry of the year. And if we see, we have a market structure low pattern getting formed. Two lower closes and one higher close. The higher close happened, which is confirming market structure low. Trend is bullish. So price is trading above moving average. Trend bullish. What we do is we select 200 points in the money option and we short. The trend is bullish. So we have to select 200 points in the money put option. So as of now, the markets where market structure got formed was at 16,200. So we select 16,400 put and we go short. When do we go short? Price below moving average, we get a market structure high which was around 324 to 20 points. So 320, wahan pe we have shorted and the option has come to 0. So we have made somewhere around 320 points. So now in week 30, from 21st July to 28th July, we have a market structure high. We have two bullish candles and we have a lower close forming with a doji. So market structure high got formed, will short the range of that market. So the range, if we see, markets have closed within the range, the expiry is within the range. So the strangle, it has closed somewhere just near the higher band. So the higher band, which is a call option, will have some value. So if you have shorted this, eventually you will have to exit at a trailing stop. But let us come to straddle chart. So when we come to straddle, we select the high point, the low point of the moving average, and the low point of the moving average is the point from where exactly the market structure high or low, the highest point or the lowest point is getting confirmed. So in this case, the high is getting marked with a bullish candle. So at that point, where the moving averages are at the same point, we select that point because that's the point from where we are going to initiate the trade. So that is used to calculate the range. So the high and low range is 16,071. The higher band range is 16,750. So the range is 16,071 to 16,752. The median range is 16,411. We go short with a straddle of 16,411. The price of that straddle is trading somewhere around 324. We have squared off this position at 180. So we made somewhere around 150 points and we have exited the position at a trailing stop. So our initial stop was not triggered. Eventually it triggered our stop loss, but the trailing one. So you are able to capture some point. The next trade is in again week 30, between 21st July to 28th July. We have a market structure low. So bullish pattern, bullish trend. So a trending market. So from the closing price, we select 200 points in the money strike, we go short. So now if we see, the markets Nifty was somewhere trading around 16,600. odd levels. So we select 16,800 put and we go short. How do we short that? We select the strike of 16,850, which is very near, and then from there the market structure high got formed somewhere around 300 points. From there we went short and eventually it has come to 0. Now in the week 34th, so it's the 34th expiry, starting from 18th of August to 25th of August. If we see, we have a market structure high getting formed, trend is bullish, price is trading above moving average, and a market structure high got formed, so our view is bearish. We have the range, so high and low of the moving average, and we select. So the high band is 17,147, the low is 17,968, the median range is 17,557. So now it's very near to 17,550. So we select the straddle of 17,550, we go short. The trade was triggered somewhere around 370 points. From there, the straddle has gone to 0. So we are able to capture 370 points. Now again in the same week, if we see, we have two bullish candles and a market structure high. The market structure high got formed very near to the moving average. So we select the range, the high band and the low band, we go short. So high and low band, if we select the range, it's a very small range. From 17,279 is the high point, the low point, the high point is 17,726. So high is 17,726, low is 729, median range comes to 17,502. So we select 17,500 straddle. So as we select 17,500 straddle, it was trading at somewhere around 280 points or 290 points to be precise. From there, the straddle has gone to 0. So we are able to capture 270 points, 290 points. Now, the next trade that we have identified is in the week 37th of the expiry, from 8th of September to 15th of September. If we see, we have a market structure high pattern getting formed. And see here, we have two bullish candles. The third candle is also bullish, gap down and price going higher, but it is still a lower close than the previous open, forming a market structure high. So market structure high getting formed above moving average is a sideways action. So we select the high point, we select the moving average point, and we go short. So the range here is 17,279, moving average is 17,726. We get again a median range of 17,500 and we go short. And we go short somewhere from 250 points, and eventually this straddle has gone to 0. So the next trade that we have seen is in the week 40 of the expiry. So somewhere around 6th of August, from 29th of September to 6th of August, a market structure low got formed. The trend is bearish and a market structure low getting formed, which is a bullish pattern. The markets have become sideways. We select the strike, which is 16,747 is the lowest point, which is the low of market structure low. The high is 17,519. The median range is 17,133. So we select a strike of 17,150. We go short somewhere around 390 points, and from there the straddle has gone to 0. So 17,150 straddle has gone to 0. The next trade is week 41 of the expiry, from 6th of October to 13th of October. Here a market structure high got formed. Price is trading below moving average. A market structure high got formed. So we are expecting a bearish move, a trending move which is bearish. From here we open the chart. We go to 10th of October. If we see, we have a lot of patterns getting formed above moving average. The price has come below moving average on 11th of October, somewhere around 12:15. A market structure high got formed. At that market structure high, we go short because price is trading below moving average. Market structure high getting formed on the option chart on the 15-minute time frame. From there we participate. The option has gone to 0. The next trade was initiated on the 43rd week, from 20th of October to 27th. In between, you see there is a market structure high getting formed. All the three candles are bearish. The first candle is a bearish candle. The second candle is also a bearish candle, but it's a gap up. The third candle is also bearish candle, which is engulfing the previous two candles. So now we understand the markets are sideways. The trade got triggered on a Wednesday. So we are holding it just for one day, one more next day. So the trade was triggered somewhere around when the straddle was trading at 140 points, 160 points. From there we saw a dip and then the price started moving higher. So we were able to capture somewhere 20-30 points, but this has eventually triggered our stop loss. So because the price went above the moving average. So in the 44th week, if you see, from 27th October to 3rd of November, in between there is a market structure high. Two bullish candle and one bearish candle which is engulfing the previous candle. We are getting a lower close, which is we are forming a market structure high above moving average. So the trend is sideways. So we know the strike. So what we do is we select the median range, we go short. 17,491 is the lower point. 18,175 is the highest point. The median range comes to 17,800. We went short somewhere around 340 points. The premium, when it closed, when the straddle closed, it closed at 250 points. So we were able to capture somewhere between 130 points in this trade. The next trade is triggered on 17th of November to 24th of November. In this expiry, if you see, there is a market structure high getting formed. Two bullish candles, smaller candles. The second candle is a smaller candle, but the third candle again is a small candle, but it has closed below the previous open. In this case, market structure high got formed. For the entire week, the markets were sideways. We selected the range of 17,945, which was the moving average, 18,417, which was the high point of market structure high. The median value comes to 18,180. From there, if we see, we have shorted this at 240 points. It has made a low of 106 and from there it has reversed. So our trailing stop was triggered at 130. So we shorted at somewhere around 270. From there we have exited at 130. So we are able to capture 140 points in this expiry. The next trade was initiated in the same week. We have a market structure low, two bearish candle and a bullish candle on the moving average. So we trade 200 points in the money. So now in a trending move, if we see, it was trading at 18,250. So we select 200 points in the money. So 18,450 put, we go short. And if we see, we have seen a market structure high getting formed somewhere around 160 points. From there we go short and it has gone to zero. One more trade got triggered on in between 1st of December to 8th of December. In this, if we see, there is a bullish candle, a gap up opening which closed above the previous candle, but the candle is red. The next day we had a gap down opening and a bearish candle, which is suggesting a market structure high. So market structure high got formed at 19,000 level. The low is 18,400, somewhere near 18,197. We select the median range. The exact range is 18,244 to 18,887. The median range comes to 18,565, which is very closer to 18,500. So we select 18,500 straddle. We go short about 226. We go short below 226. From there, the straddle has gone to zero. So we are able to make somewhere around 230 points. So if we see, on 15th of December, we have a market structure high. The market structure high got formed. There is a bullish candle. The second candle is a bearish candle formed with a gap up. It's still a higher close. The third candle is a lower close with a bearish candle. But if we see, this market structure high is getting formed on the moving average, whereas the price is bullish because it is on the moving average, right? It is coming above moving average. The price is coming from above toward on the moving average. So the trend has to be considered bullish, but the pattern is bearish. Now in this case, if we identify the range, we won't find a range because the closing price of the bearish candle and the moving average is almost the same. When it is almost the same, you cannot identify the range, right? You will get 1 point, and just based on 1 point, you cannot trade a straddle. So this is the reason whenever a market structure high and there is no trend or anything that is getting formed on the moving average, whenever the market structure high or low gets formed on the moving average, whatever information that we get becomes a non-directional information. That is the point where we don't trade. So in most of the cases, when we see, we have traded straddle and strangles whenever market structure high and low is getting formed, but they are getting formed away from the moving average. So we get a range. But what if a market structure high and low is getting formed in the opposite direction of the trend? That means we'll not have the exact range. We'll get 1 point, and based on 1 point we cannot initiate a strangle, neither a straddle. At this point, in the direction of the trend, if we get the similar structure, if we see A market structure low getting formed on the moving average is a positive sign because we are trading 200 points in the money and it's a single leg option. So we trade that. If we get a market structure high below the moving average, we trade that because the trend is bearish, pattern is bearish. But what if the pattern is bearish and trend is bullish? And it is the pattern, the bearish pattern in a bullish trend is getting formed on the moving average. That means the market is still confused. We are not getting any direction. So we don't trade. So this is the zone where we don't trade. So this is the last trade of year 2022. So we got market structure low between 22nd of December to 29th of December. If we see two bearish candle and a bullish candle, the bullish candle, which is completing the market structure low, got formed below the moving average. That means we have to trade a straddle. So when we trade a straddle, we select the price which is at the lowest point is at 18,244. Moving average high point is 18,887. We get a median value of 18,565. We should go short with 18,565. We have gone short somewhere around 260 levels and we have covered the position at 90. So on expiry day, the premium was at 90. So we are able to capture somewhere around 170 points in our last trade for the year of 2022. So these are all the trades that we have selected for the year 2022. We have taken which are the best places where you have to participate, both for trending and non-trending phases. So I am sure you have got a complete idea of selecting the range. Range is very critical before selecting the strike. So we understood how to select the range. Once we have identified the range, we select the median price and we select from the median price we go to the nearing strike which is available to go short based on the straddle. This is how you select the range. You go short with the straddle. If you just want to trade the range, you can trade strangles because the nature of the strangle is such that the premiums will be very less. As we are trading straddles, where one of the strike can be in the money, one of the strike can be out of the money. This is where the best combination, best premiums you will get. This is the scientific method from which you can select the range and it is coming purely from price and trend. It is very straightforward and if structures are getting formed in the direction of the trend, you just participate the trend. It's the most easiest thing. So in this, we have selected the example of directional and non-directional. I hope all this example helps you fine tune your trading.